Welcome to the 2021 Stock Market Outlook. We're very excited to have you and for this jam-packed session teaching you everything that you need to know about what is going on with the stock market. What can you expect in the future? So as we get started here, let us know in the questions box or the comment section where you are listening in from and how the weather is. We're going to jump right in here. Today we're going to be talking about the overview of the 2021 stock market performance. We're going to take a look at the factors on why the stock market could go up or why it could go down. What happens during times of inflation? This is one of the biggest concerns right now in the stock market. What will happen with your investments during inflation? And how to prepare for the next market crash. Stock market crashes are inevitable. It's not if they're going to happen, it's when they're going to happen. So how do we prepare for the next one, which is coming? And what's the best strategy going forward? So this is going to be a jam-packed class here today, and we're really excited to have all of you. So let's get started here. Before we get started, let us know if you can hear us okay. Let me know if the audio was good. If you could see my screen, just put in 2 yeses in the questions box. Awesome. Welcome. We have Burlington, Ontario. Welcome, Haley. We have Kamloops. Amazing. Welcome, Kamloops. Amazing. Thanks, everyone. So let's talk about the year-to-date update. How is the stock market doing so far? So the US is off to a strong start this year at a 16% return. They have just been on a roll for the past 10 to 20 years. Good to see Canada having a good year. We're at 15%. Woohoo! We struggled last year, guys. In 2020, we only had a 2% return, while US had an 18% return in the whole year. So it's great to see Canada having a strong year. Shanghai, which is the China markets, have been getting crushed. Oh my gosh, it's tough to watch. But the government policy is causing these China stocks like Alibaba, Tencent, JD.com to just go lower and lower and lower. The Europe markets, which is a FTSE 100, they're at 8%. In Bitcoin, 11%. It's been a little bit of a roller coaster ride. Bitcoin went all the way up, got sliced in half, but still up 12% for the year. So let's talk about the S&P 500. For those of you that don't know, the S&P 500 is the largest stock market index of 500 of the best companies in the world. You could see like Costco, Apple, Microsoft, Visa. And this is how it's performed so far this year. And it really tells you a story, and there's a lot of lessons to learn here. We started off with a strong, really strong start, and then in around February, late January, February, there was that stimulus bill, $1.9 billion President Biden released, and the markets got scared. They're like, whoa, you can't just be printing all this money. So you saw a huge decline there. And then what happened is the markets went up, and then they went down, and then they went up, and that's just how the markets perform. There's so many lessons that you can learn from this right here. This is how the stock market performs. It takes 2 steps forward and then 1 step back. It never goes up in a straight line. I wish it did. It would really make sleep a lot easier, but that's not how they perform. They always take 2 steps forward and then 1 step back. So as an investor, when are the best times to buy? The best times to buy are during these dips. They're during times of fear, where the news is inflation is on the rise, China and US tensions are rising. There's a lot of pessimism in the air where the markets take a step back. Those are the best times to buy. But if you look at this chart, a really great time to buy is now, because the markets just keep going up and up and up. Never goes in a straight line. It will take a step back, but don't wait to invest. Get started now. If you look at this chart so far this year, if you invested any time before July 10th, you would have been positive. You would have been making money. There's never a perfect time to invest. Now, in the comments section, we want to ask you all a question. What do you think the annual rate of return is for the S&P 500 from 2010 to 2020? So during those 10 years, what do you think the S&P 500 average rate of return was? Let's see if anyone can get this answer. Put your answers in the comments section. Okay, Isa said 8.5. Good guess. Jackie says 10%. Barbie says 10%. Great guesses. Mary Brown says 15%. Sharon, 12%. So the correct answer is 13.7%. The S&P 500, it's such a unique place to invest your money because you're investing in 500 of the very best companies with the smartest CEOs in the world, the top marketing teams, companies investing billions of dollars in technology and innovation with one goal: to grow and make money. What a great place to invest, a unique place to invest your money. Now, let's talk about why the stock market could go down. There are some really big concerns right now with unemployment, inflation, and it's important not to ignore these. We have to take a look at these and look at the facts. Right now, one of the biggest and growing concerns is inflation and possibly entering hyperinflation. That could cause a major market decline. A little bit later on in today's class, we're going to talk about what happens when the markets reach inflation. How do the markets react? What happens? So we'll walk you through that. But this is a big concern. If prices keep going up, housing and stocks and cost per living, it may enter hyperinflation, which is not good. That is not a good thing. Another big concern is the third wave. You take a look at the Delta variant, and it's kind of on the rise a little bit. Right now, the average cases in the US is around 100,000 new cases a day. At a low, it was 15,000. Now, it's nowhere near how many it was, a couple 100,000 cases a day, but it's creeping up. We got to be careful. Another concern is global debt. The debt of the world is increasing and increasing, not just in Canada or the US, but everywhere. And that's another concern as well. Now, why could the stock market go up? There's a lot of reasons as well. I think the biggest positive thing that's going on is the unemployment rate in the United States has dropped. From June 2020 was 11%. In June 2021, it was only 6%. So half, more and more people are going to work. And that's really good for the economy because when people go to work, they get paid. When people get paid, they're going to restaurants, they're going to movies, they're traveling. They are spending money to fuel the economy, and businesses get money. So this is a really positive sign. Now, another extremely positive sign that honestly shocked me is how good businesses are doing. Corporate earnings have been very positive. Now, for those of you that aren't familiar with earnings season, it happens every 3 months where basically these big companies, they have to reveal how they're doing. Are you guys doing good? Are we doing bad? Now, what happens is analysts, they set a benchmark on how the company should be doing. They use a metric it's called earnings per share, and which is basically the profitability of a company. So companies can either be doing, they can match earnings, they can beat earnings, which is amazing. If you beat earnings, it's like a celebration, like, woohoo, we beat earnings, let's celebrate. If you don't beat earnings, it's bad. It's not good. So here were the estimated earnings for Q2. So this is of June. Apple $1, Microsoft $1.90, Facebook $3, Amazon 12. So these are where the analysts said, here's where we think earnings will be. But here's where the actual earnings were. You could see like just absolutely far exceeded the estimated earnings. And what this tells us as investors, these companies are doing well. They're outperforming. And this is a great trend. When these companies are doing well, it means people are buying their services. It means the economy is doing well. So that's been very positive. I saw this article, the S&P 500 is on track for the best quarterly earnings growth since 2009 as companies smash expectation. Businesses are booming, and that is a good sign. Now, another good sign is this optimism index. Americans are very optimism. Canadians as well. You take a look at it, we're at like 50, and in 2020 it was really bad. But overall, the optimism of individuals for the economy and how things are going is positive, and that's a good sign. This was another interesting thing that we saw. Now, this is data that tracks the footsteps in the US, okay? And you can see there's an increase in amount of people going to bars. I think that's one of the first places people are going to after COVID being locked down, the bar. But you can see there's a rise there. There's a rise in hotels. That's a great sign because that means people are traveling and they're traveling. That's great. Movie theaters are up. Restaurants are up. This is a good sign. This is showing that the economy is opening up. But this can all go out the window if there's a third wave. Like, honestly, if the Delta variant just takes off, this is all thrown out the door, right? So it's so hard to predict the future. And we're not here to try to predict what's going to happen. We're here to help you create a portfolio that whether the markets go down or whether they go up, you're going to be earning money. You're going to be protected. And that's what successful stock market investing is all about. It's not trying to predict the future because nobody can. It's about being able to prepare whatever the future holds. And it all starts with asset allocation. I'll talk about that a little bit later. Now, in the comments section, let us know, how do you think the markets will perform in the second half of the year? So please take some time to do this. I'd love to see everyone's opinion and thoughts. Let's see if there's a trend. Let's see if overall we're very optimistic or pessimistic. But also give your reasons. So put in, do you think the markets are going to go up and why? So you can say, Arian, I think the markets are going to go up because companies are, recording record earnings. So let us know in the comments section. How do you think the markets will perform in the second half of the year? Okay, we have down due to the overprinting of money. Dr. Paul Charlton, a lot of money printing going on. Global debt on the rise. Above average. Awesome. Thanks everyone for taking the time to put your answers in the comments section. It's always interesting to see what everyone thinks. Okay, Haley says, correction in winter due to the third wave and overvaluation. After this next fall in the market, it will pick up slowly again. Sharon, thanks so much for your input. So really great input and interesting to hear everyone's perspectives. Now guys, if you're enjoying today's class, we are going to be running some weekly classes just like this. We have how to prepare for retirement coming up, no money down real estate investing. I'm really excited for that one. Credit card hacks, robo-advising, how to lower your monthly bills. So if you would like to get access and register for these classes, there's going to be a link in the chat box. There's also a link in the description. Sign up for the classes and get access here. They're totally free, and you'll also be on our Financial Friday newsletter, which is a weekly newsletter on a different financial topic. So you can make sure to register for that. Now, let's talk about some important questions like inflation. What happens if inflation rises? This is a big concern for a lot of people. So what we did is we went back and we studied inflation, and there isn't a direct correlation that you can say these are the exact things that are going to happen. But usually three things happen. Number one, inflation rises, and it's rising right now. But we're still not at the point where it's time to panic. It's not hyperinflation yet. If it keeps going at this pace and we reach a level of hyperinflation, the Federal Reserve will step in. They're going to come in and say, okay, inflation is out of control. We got to fix this. And they're going to increase interest rates. One of the biggest reasons inflation is on the rise is because interest rates are so low. But the Federal Reserve, they had to lower interest rates, and countries all around the world had to try to stimulate the economy a little bit. And it's worked. You could see Canada real estate's going incredibly well. The US, the economies are stimulating because money is so cheap to borrow. So people are borrowing money to invest and to renovate their home and to buy that cottage, to go on vacation. We don't recommend that you take a home equity line of credit or a line of credit to renovate your home or to buy a vacation. You shouldn't do that. But to invest, it makes sense. Borrow money at 2 to 3%, invest in an asset that's going to get you a 10 to 15% return, and you can write off that 2% interest. It's a no-brainer, and you see that happening. Now, if inflation gets out of control, the Federal Reserve will increase the interest rates. People won't be borrowing money as well, and that will slow down the economy. So what's going to happen to the stock market? It can go up or down. It's hard to predict what exactly will happen. Short term, you will probably see a little bit of a downturn, not a huge amount, like a couple percentages just from the shock of the economy. People are going to be like, oh my gosh, the Federal Reserve, they're increasing interest rates. They can't do it. The economy needs low interest rates. And then stocks are going to go down. But over time, what's going to happen? They will recover. Okay, another important question is, will the markets crash again? Will we see another stock market crash? Yes, we will. It is almost guaranteed that the stock market is going to crash again. We just have no idea when. It could be later this year. It could be next year. It could be in the next 10 years. We just don't know. Now, if you're someone out there that can find an expert, someone that's consistently predicted the market crashes, please let me know. In most cases, there's no one that I know of that can consistently predict the market crashes. Some people say, oh, this individual or that individual. But if you actually study their predictions, they get a lot of their predictions wrong. But the ones they get right, everyone highlights them. Everyone makes movies about them. They write books about them. So try to find me an expert that's consistently able to predict the markets. And if you can, send them my way. I'd love to study them. Warren Buffett, one of the most successful investors of all time, he says, guys, I don't think I can make money by predicting what's going on in the next week or the next month. I do think I can make money by predicting what will go on in the next 10 years. And it's important to remember, guys, the stock market, it's a roller coaster. There's ups and downs and ups and downs, and sometimes it's out of control. But when you're on a roller coaster, the worst thing that you could do is just get off in the middle of the ride. You gotta stay on. You gotta know your plan, your long-term strategy, change your asset allocation, but you can't get off in the middle of the ride. Now, history can teach us some incredible lessons. So what we're gonna do, we're gonna go down memory lane, and we're gonna take a look at some of the biggest stock market crashes from 1957 to 2020, and we're going to study them. So let's take a look. Here's a chart. We tried to make it really simple. On the left-hand side, you're going to see the year of the market crash. The column right next to it, you're going to see how long did it take to get to the bottom. So the amount of days it took for it to hit rock bottom, that's what that second column is. Percentage decline shows how much the markets went down, and then how long did it get back to the top, right? So when it hit rock bottom, how many days did it take for it to recover? So you can look at 2009, guys. Let's take a look at that. Down 57%. Oh, imagine seeing your portfolio go down by 57%. Oh my gosh, that is brutal. And what was interesting about that market decline, look how long it took to get to the bottom, 335 days. It was just a long, slow decline, just kept going down. And it took a long time for it to recover, almost, 2 to 3 years for it to actually recover. Look at 2020, how fast. It was one of the fastest market crashes in the history. 31 days it took for it to hit rock bottom, and it recovered really quickly as well. So every stock market crash is different. You can't treat them the same. So how long did it take to get to the top? You see that in the amount of days. Again, you look at 2009, it took 1,000 days, almost 2 to 3 years. Same with 2020. And then the next 12 months, this is one of my favorite charts because it shows you what happens when the market crashes. What do the next 12 months look like? And you can see they're just so resilient. The stock market is so resilient. It will crash, it will go down, but it will always recover. And when it recovers, it gets stronger and it goes higher. And that's what I love about the markets. There's never been a time in the North American markets where it's crashed and never recovered. So trying to bet that we're just going to have the stock market is just going to go to zero, that is not a good bet. And if it does go to zero, there's bigger issues going on in the world than money, right? It's like you're talking about like a pandemic times 1,000. What we just went to, way worse. I can't even imagine. I'm trying to think of ideas like what would have to happen. You're talking about like worst case scenario. So let's talk about the trends. To be a successful investor, it's so important that you're fact-based and not emotional. So here are some of the facts about the stock market and stock market crashes. A bear market happens every 3 to 5 years. A bear market is when the markets go down by 20% at least. So every 3 to 5 years, you should expect the markets to go down by 20%. You should expect your portfolio to lose 20% of its value every 3 to 5 years. The reason 2020 shocked a lot of people is we didn't have a market decline like that since 2008. We had a small one 2017, 2018, but it was really 2008. That was the big one. The average loss is 30%. Okay, so when the markets crash, they go down by about 30%. Now, sometimes it's a lot more, sometimes it's a lot less. That's the average. Okay, so expect that every 3 to 5 years, I'm going to lose about 30% of my money if I sell. The average bear market lasts about a year. So when the markets go down, it takes about a year for it to recover. Now, this is my favorite stat. I love this stat, and you should highlight this. You should put this on your phone. You should print this, put it on your wall if you're a nervous investor. 100% of bear markets are followed by a bull market. When the markets crash, they always recover. You will only lose money if you sell. So don't sell. That's a huge mistake people make. They freak out. Oh my gosh, COVID-19 is a pandemic. It's a health crisis. Let's sell. And then the markets recover and people are now buying like at this time. And that's how you lose money. That's how most individual investors lose money. So the golden rule is this: whether the markets go up or whether they go down, your portfolio should be set up to make money in the long run. That's the key. How do you set up a portfolio where you are making money in the long run? Okay, now another question we get a lot. People ask, Should we buy and sell individual stocks? You can try, and it's not bad to have a portion of your portfolio buying individual stocks. I do, but I cap it. I say, okay, no more than 10, 15, 20% of my money is in this portfolio. And it changes for everyone, it changes during the times. For example, for myself in 2020, I went a lot more buying individual stocks because you saw them at such a huge discount. Now, as the economy is recovering, I'm getting out of those individual stocks and going more into those index funds and these ETFs. You can buy and sell individual stocks. You just have to remember the odds are against you, and it needs to be a part of your asset allocation. You should have a plan, like a piece of paper, you know? And on your piece of paper, you need to have the percentage of money that you want to put into Bitcoin, into cryptocurrencies, into individual stocks, and it should never exceed that amount. Now, the stock market has averaged about 8 to 12% return, depending on the market, over the past 20 years. In the comments section, what do you think the average yearly return of individual investors has been over the past 20 years? Put your answer in the comments section. What do you think the average yearly return of the individual investors has been over the past 20 years? So the market was around 8 to 12% return. Okay, great guess. Ask Jill Mary, 5.6%. If you're not already in the comment section, let's join the conversation. Bill said 4.9. Lacey, thanks so much, Lacey, for putting in your comment, 6%. Valerie, thank you, 10%. Andrea said 10% as well. Great guesses, everyone. Okay, let's take a look. The individual investor came in at 3.8%. Oh no. How is it only 3.8%? What's going on? Well, the biggest reason individual investors are horrible investors is because we're so emotional. We buy when we should be selling, and we sell when we should be buying. Another reason, frankly, it's just very difficult to outperform the market. Even if you give your money to a hedge fund or a mutual fund, which is a group of professionals like this, very smart professionals trying to outperform the markets for you, the average return of these professionally managed mutual funds and hedge funds over the past 20 years has only been 5.19%. It's just hard to pick a group of stocks that's not just going to do well this year, but years to come. It's very, very difficult. So your best bet as an investor is to invest in the markets through an index ETF. Now, I'm going to show you why it's also another example of why it's very difficult to pick winning stocks. What do you think was the best performing stock in the S&P 500 in the past 20 years? So the S&P 500, 500 of the largest American companies, what do you think was the best performing stock in that group? Now, whoever gets this first, we're going to give you a $50 Amazon gift card. So quickly put in your guesses. What do you think was the best performing stock in the past 30 years? Okay, we have Amazon. Great guesses, Georgina. Okay, a lot of Amazon. Google, great guess. I don't think anyone will get this. Coca-Cola. So if you haven't already, you still have a chance. Microsoft, Patrick says, nope, not Microsoft. Apple, good guess. Spotify, nope. Carlene, Spotify's still a little newer. Ooh, Dill, good guess. Tesla, that's a good guess. Nope, not Tesla. Walmart, General Electric, Coke. This $50 is on the line. Come on. Who's going to get this? Zoom. Okay, we'll give a couple more guesses. 3M. Oh, not Netflix. Oh, I'm having fun here. Adobe. Nope, not Ford. Ah, I really want to give this away. Oh, there we go. Everisa says Monster Beverage. You are correct. So congratulations. Monster Energy Drink was the best performing stock in the past 30 years. How crazy is that? Does that make any sense to anyone? An energy drink had a 358% return in the past 30 years. So reach out to us. We'll give you your $50 Amazon gift card. Way to go. That is absolutely like crazy. How does that work? Now, this was interesting as well. So in 2008, Warren Buffett made a public service announcement, and he basically said, hey, listen, any fund that can outperform the S&P 500 over the next 10 years, I will give them $1 million. A little bit of a bigger bet than what we do at Enrich with $50, but Warren Buffett was willing to give $1 million. But he said, here's a caveat. If you can't outperform the S&P 500, you have to give me the $1 million. Now, the money was going to charity, which is great. So from 2008 to 2018, the winner was, of course, Warren Buffett and the S&P 500. They had an 86% return, which is great. Now, Protege Partners, which was that hedge fund, they did pretty good. It was close. They got 21%. Right? So I'm joking. They weren't even close. It was an absolute blowout. It wasn't even close. Like 21% versus 86%. So guys, at the end of the day, it doesn't matter who you are. It is hard to outperform the markets consistently. You may be able to outperform in 1 year, 2 years, 3 years, but over a sustained period of time, 10 plus years, is very difficult. So if you find a mutual fund or a hedge fund that says, hey, invest with us, we got a 30% return in 2020. First of all, it's very easy to get a great return in 2020. But ask them, hey, what's your return been over the past 15 years, not just last year? And you're going to see that number is way less than what the markets are. Another question we get a lot is, should I pay attention to the news? You just have to be very careful where you get your information nowadays, because think about it. News companies are like any other business. Their goal is to make money. Now, how do they make money? Advertisers. The more advertisers are on their newspapers, on their news outlets, the more money they get paid. So the more viewers, the more ads. So they spend their entire time thinking, how do we get more views? How do we get more views? How do we get more people watching the news? And that's where clickbait is coming in. That's where these stories that are just not true, that are twisted just to get people's attention. You have to remember, guys, pessimism is persuasive. I'm not here to say that you shouldn't look at the bubbles, you shouldn't look at all the concerns, but this pessimism is very, very persuasive. And I fell into this trap. I've lost a lot of money early on in my investment career by following these pessimism bets, and you get hooked in. Now, you take a look at on YouTube. Look at this. Here's some positive videos. The Road to Economic and Stock Market Recovery in 2021, 4,000 views. Spending and Stimulus Suggests Strong Economic Rebound, CNBC, 5,000 views. CNBC, their channel usually gets hundreds of thousands of views, but no one wants to watch a positive video. Look at these ones. These are negative videos. Why Grantham says the next market crash will rival 1929 and 2000, 2.2 million views. I watch that. How can you not click on that? How can you not click on something that says this next stock market crash will be worse than the Great Depression and the dot-com boom or bubble? Look what Harry Dent said. Stock market to crash 40% by April. Won't rebound for decades. Here's why. First of all, that was wrong. It didn't happen. I had to watch that as well. How can you not? It's so convincing. It's so persuasive. Pessimism is persuasive. Here's some other highlights of what we saw. Great corona crash of 2020 is different. A hellish week for the markets isn't over yet. Jim Cramer said on Monday, I'm convinced there will be more selling. And I like Jim Cramer. I think he's got some good stuff. But when you're trying to predict the future, it's impossible. He said the markets will continue to go down. He was convinced there will be more selling on April 6th, 2020. It was at this date. You know what happened after he said that? The markets just went straight up. Not straight up, they were up and down, but they went up. So again, be cautious of the news that you watch. Be careful. Be very careful. So what is the best strategy going forward? How should you look at your investments for 2021, 2022, and beyond? Number one is the most important thing is determine your asset allocation. If you ask the most successful investors of all time, they will all say your asset allocation is the most important factor to successful long-term investing. It's how you distribute your money. It's how your money is divided. If you've never heard of what an asset allocation is, you shouldn't be investing. If you don't have an asset allocation right now, you can't say it right now. Like, okay, my asset allocation is 30% US stocks, 30% Canadian stocks, 30% international, 10% Bitcoin. If you don't know what your asset allocation is, you should not be investing. If you want to invest in individual stocks and cryptocurrency, fantastic. We're going to do more classes on individual stocks and crypto, but it needs to be a part of your asset allocation. And a lot of people get confused. They think successful investing is picking the right stock, but it's not. It's choosing your right asset allocation and adjusting it based on your life circumstances. Create your investment plan and principles, stick with it. This is another important one. Investing without a plan, it's like going on a road trip without a GPS. Good luck, right? Like that is not fun. Number three, be a logical investor. Do not let your emotions get the best of you. Watch out for the news. And then finally, invest on a consistent basis. Every month, you should be investing a specific amount. Now, if you're someone that wants to be more advanced and try to pick the times when to invest during those dips, something that I've done in the past is I've taken a look and said, okay, I'm going to invest a certain amount each month. Now, throughout the month, I'm going to look for the dips, and I might just buy it on the 15th of the month because there was a big dip, and then I won't for the next month. But you have to have a rule, and you have to tell yourself, if I am not able to invest by the end of the month, I have to purchase that set amount by the month end. Because here's the problem. If you're trying to wait to see when the markets are going to drop, you could be on the sidelines for 7, 8, a year, and you're not investing. So you got to invest each month. Within the month, you can pick and choose when to invest based on the dips. But if you're not invested by the end of the month, you have to invest. So guys, I hope you've enjoyed today's class. Guys, we're going to have a lot of questions and answers. If you have enjoyed today's class, if you would do me a favor and just hit the like button of the video. If you're on Facebook, on YouTube, it would just mean a lot to us. It would give us, honestly, reassurance that you like these videos, you want to see more of them, that we should invest the time and the money to producing these. So click that like button. It would help us a lot and spread the message of financial literacy. Now, for those of you that are familiar with Enriched Academy, we are on a mission to make financial freedom accessible to everyone. Our financial literacy resources are trusted by over 150,000 individuals, including school boards, universities, and even governments. We have partnerships as well with corporations and associations. And what we've learned over the past 10 years is there's really two types of learners. And the first step to increasing your financial literacy is understanding what type of learner are you. So there's two. Number one is you're someone that's self-accountable. I love all of you people out there. I don't know how you do it. You're accountable. All you need is the education, the tools. You have this discipline and this willpower to do it on your own. Kudos to all of you. I don't know how you do it, but those individuals exist. They're rare, but they exist. There's another group of people that need coaching and guidance. You're someone that wants to achieve great things. You want to do better with your money or working out or cooking, but it would really help you if you had an expert by your side helping you out, telling you what to do, pointing you in the right direction. So guys, again, the first step to really increasing your financial literacy is figuring out what type of learner are you. So put it in the comments section. Are you self-accountable, or do you need a coach and do you need accountability? We got a lot of great questions coming, so we're going to answer them, but let us know in the comments section, what type of learner are you? Okay, yep. SJ says coaching. Jasper, kudos to you. Self-accountable, way to go. Paul says, I need some coaching. A good way to know if you need a coach is just ask yourself, in the last year, if you've watched videos like this, if you've read books, how much of that information have you actually done something with it? And that was a big aha moment for me as well. It's like, okay, I'm learning a lot, but I'm not actually doing much with this education. Awesome, Mary. Thanks so much. Mary says, I've taken the Enriched Academy program, coaching program. It's the best I've ever taken. Yeah, you know what? Let's keep going here. So if you are self-accountable, at Enriched Academy, we have this amazing online dashboard to learn financial literacy. There's these great financial tools. We interviewed 35 of Canada's and top financial experts. You have great tools here, from how to increase your net worth, getting out of debt, investing, retirement planning. The tools are so easy to use. You don't need to be like an Excel genius. And the best part about them, they help you make the tough financial decisions. They help you bring clarity to your money. And I love this one. This is the net worth tracker. It helps you track and grow your net worth. But really where the magic happens is when you go and look at all of our courses. We have different courses, from how to improve your credit score, investing in stocks, retirement planning. And the courses, it's like Netflix for money. They're really fun, entertaining videos on different financial topics. So if you've enjoyed today's class, our online course is 1,000 times better. Like, it's not even close. It's a live event that we filmed. We have invested hundreds of thousands of dollars developing it. And by the end of the course, you're going to have a really strong foundation to create financial freedom for you and your family. And we have another program, which is one-on-one coaching. This is really for people that, you need more hand-holding. You need more guidance. Our coaching program will really change your life. What's going to happen in 6 months, you're going to get a financial expert that's focused on you and your unique situation, and going to give you advice that's in your best interest, customized to you. The challenge with the education like this, it's very general. And that's great, but imagine how effective this would be if me and you had a conversation and I sat down with you and I asked, hey, what's your asset allocation? Where are you currently at with your investments? Oh, you're not investing? Then I could focus on that. That would be like, imagine you're able to do a one-on-one call with me or another individual. That's how powerful a coach is, because they can customize it based on your situation and your goals. Now, the best part about coaching is that it really works. It is an investment of money and time, but if you look at the results in just 6 months, our average coaching student increases their net worth by almost 50 grand. This is the first 6 months of 2021. We just got these new stats. Net worth increased 28 points. Advisor fees saved 1.25. Monthly spend $1,200. Without getting another job, our average client is able to put $1,200 back into their pocket. And guess what they're doing with that money? Investing it. Yes. Decrease in credit card debt. And a new stat that we're tracking is passive income increase. So what we're offering all of you here today is a free financial assessment call. It's 100% free. It's with a financial freedom consultant to really help you plan for your future. It's a 45-minute call. It's a really great call. It follows a 4-step approach. So the first thing we're going to do is we're going to look at your financial situation. Where are you currently at? Are you investing? Are you not investing? Do you have debt? Are you retired? Are you getting close to retirement? Where the heck are you at? Until we understand where you're at, we can't help you. Then we're going to identify the root causes. We need to figure out what are those big roadblocks in your life and how do we overcome them? Next, setting goals for your future. How do we create realistic goals for your financial future now and into retirement? And design your path forward. We're going to talk about your different options. You could go path A, path B, path C. So it's a confidential call. It's a one-on-one with a financial freedom consultant. And guys, no matter your financial situation, even if you don't know anything, or even if you're an expert, why not do this call? It's free. The worst case scenario, you don't get anything out of it. The best case scenario, you get 1 or 2 ideas that could change your financial future. So check it out. There is limited availability. So if you would like to book your call today, there is a link in the chat box and in the description. So make sure to click on that link, book your call. Again, spots are limited. We only have a few individuals that are doing these calls, and it's going to book up from this class for sure. So make sure to book your call. You could do it as soon as this week or next week. Pick a date and time that works best for you. So that being said, now let's go into the Q&A. Again, I hope you enjoyed today's class. If you did, like this video, subscribe to our YouTube channel. We want to do more videos like this if it's been helpful for you. If this video doesn't get a lot of likes, then we may not do these videos because it takes a lot of time and effort to put this together. It doesn't seem like it, but this was like 40 hours of effort, and we had to get our PowerPoint designers, a lot of study, a lot of research. So I hope you enjoyed it. A simple like, it takes a couple seconds, would mean the world to us. So now let's take a look at some of the questions we have here. Ooh, nice, a great question here. Which trading platform do you recommend? Oh, I personally use Questrade. I love Questrade, but there are some great ones out there. If you go online and search top performing or best online platforms to invest, you'll get a great list. They talk about the pros and the cons. Awesome, Jackie. I'm glad you enjoyed today's class. Thanks for attending. And completely agree with you. It's worth investing in yourself. Wealth Simple Trade is a good option. Absolutely. Oh, I like this. Sharon says, you mentioned borrowing at 2% to invest with a return of 15%. I mentioned 10 to 15%. Where do you get that return aside real estate? So Sharon, there's three different sources of investments that we're big fans of. The markets, right? Like individual stocks, real estate, private second mortgages. Okay, so those are three different ones. Now within each one, there's so many. Real estate, you could do pre-construction investing, you could do wholesaling, you could do flipping, you could do buy and hold. So there's really not one size fits all. What you do need to do is figure out your risk tolerance, figure out where you want to invest, what you want to study, get really smart in that investment, and then go for it. If you want to do Airbnb real estate properties, great, but you got to be an expert at that. Very informative. Awesome. Glad you enjoyed it. Okay, getting a lot of questions on asset allocation best practices. Yeah, it's a tough question because there is no one size fits all. It's a really customized approach. I've personally changed my asset allocation a handful of times, but I am very different from all of you. Just because my asset allocation is a certain way doesn't mean yours should be. So what you should do, Jackie and everyone else, go online. There are some great asset allocation tools. Um, I also like signing up for robo advisors. You don't have to use them, but with a robo advisor, you can go through the process and they will determine an asset allocation for you. And that will hopefully give you some ideas and some insights on what your asset allocation should be. Jag says, what is your view on dividend and REIT ETFs? Yeah, Jag, I think they can be great. I love REIT ETFs. It's like investing in real estate without all the hassle of actually owning an investment property. Now, your returns are going to be a lot lower, substantially lower. You don't get the appreciation. So there's pros and cons. I myself, I invest in actual real estate. But if you're someone that doesn't want to deal with that headache, a REIT is great. But just like any ETF, you need to do your research. You need to know if it's a good quality one. Yes, guys, so today's link is going to be available for 7 days on YouTube and Facebook. After 7 days, we're going to take it down. So if you want to rewatch it, you absolutely can. And you can share it with a family or friend. Please do. Again, if you like today's class, please take a second to hit the like button and subscribe to our channel. Okay, will stock market be taken care of also in coaching? Yes, absolutely, Emily. So during the coaching program, if you want to focus on stocks, our coaches are educated and equipped to help you create a stock market strategy. Whether it's doing it on your own, robo advising, they can absolutely help you out. We recommend to go the passive approach. All right, guys, that looks like that's all the questions. I'm sorry if we weren't able to answer them, all of your questions. If you would like to reach out to us, support at enrichedacademy.com. We are back next week. We're doing a great class on retirement planning. So click the link in the description, sign up for that class, and if you still have questions, you can ask them on the class. Again, thanks everyone. I hope you enjoyed it, and we'll see you real soon. Bye for now.